Welcome to part 2 of this Introduction to Cost Accounting video. In this video, we're going to be examining trends in cost accounting through the lens of the value chain. So you can see all the different components of the value chain already listed here for you. We're going to look at ethics, and we're also going to briefly touch on the Code of Ethics from the Institute of Management Accountants. So here in the last video, we talked about the value chain and how, as accountants, we provide information to managers to help them create value throughout the organization through the use of the value chain. Value chain, or anything of value, is in the eye of the customer. So you won't see things like accounting up here or human resources, because customers typically don't value those things. They value things that make their products cheaper in price, or they value things that make their products of more quality. We're thinking about this from the perspective of the end user, the customer, but we're still going to examine it with cost accounting in mind. So in terms of research and development, how can cost accounting help with research and development? Well, we have this technique called lean manufacturing. So in lean manufacturing, we try to eliminate as much waste as possible, and we focus on being efficient and effective, particularly cost effective. So all in the design of our product. We ensure at the very beginning that we are designing the product in the most cost effective way. You hear in the news information about chip shortages and how that is going to impact the number of cars that we're going to be able to buy in the near future. Companies are well aware of the chip shortage because they did their homework in the research and development stage, and they determined who they were going to get the chips from, and they had a price that was already locked in. So now with this chip shortage, of course, it's throwing things into chaos, but it's just a manner of, with that lean manufacturing technique, we're being cost effective and we are being efficient from the very beginning by doing our homework, investigating, pricing out things early. Now, in terms of design, after we do all the research and development, it's time to develop the prototype. And with that prototype, there are detailed specifications on what materials we need to use to make the product. How much of that material do we need? How much will that material cost? This is known as design for manufacturing. We focus on all the activities that are needed to make the product, and each activity has a cost assigned to it, and we collect those costs in something called a cost pool. Then we assign those costs to the product because we've already done the estimation ahead of time. After, of course, the product is made, then we're able to assign the cost to the product later on. This is known as ABC costing. We have an entire chapter devoted to ABC costing in the future, but this is how cost accounting helps in the design phase. In the purchasing phase, now remember, in the first two phases, we already did a ton of the homework, so we know how much the materials should cost. So we use benchmarking methods because we know how much it should cost and how much we need to make our product. We can then measure at the end of the period to determine whether or not we got those actual prices, or whether or not we use that much material. So benchmarking is an ongoing process, and we look for any variances. And if there are variances, we investigate why. Sometimes it's a problem on our end, sometimes it's not. But the cost accountants are the ones who provide the information in terms of the starting point, what the benchmark is, and we collect the data to determine whether or not we actually met the benchmark. In the production phase, we jump back to that lean system again. So a lot of companies use what's known as just-in-time manufacturing, meaning they will wait to order the raw materials just in time for them to need them, so that they're not holding tons of inventory, and they can lower the cost of inventory because it costs a lot to store inventory. The problem with this is that it makes our supply chains very sensitive, and it makes our product production very sensitive. So any delay in the supply chain because we're ordering things just in time, end user customers always tend to feel those because with a just-in-time inventory system, we're getting things just in time to be able to make the product. But it does make us more efficient, it makes us more effective, and it does lower the cost of inventory. In terms of marketing, we use customer relationship management systems. And these systems collect data about our customers. And from a customer perspective, 10 years ago, this was really, really creepy that companies were collecting all of this data on us, and then they would email us on our birthday to say happy birthday or offer us a coupon on our birthday so that we could come back to their store. But now I believe a lot of us have become accustomed with handing over all of our information to Facebook and Twitter and Instagram and all these different companies, and they collect all that data, build a profile on us so that they can sell us stuff. Low-cost accountants are helpful in collecting that data and providing that data to the marketing individuals so that they can then, again, sell us more products. Cost accounting is definitely used in distribution and our supply chain. A lot of our distribution is outsourced. In the United States, with a lot of other companies, they may use UPS to deliver their goods. Walmart will outsource their delivery portion. Even, I can't think of the name, Instacart is a sort of a form of outsourcing distribution, because the people who work for Instacart will deliver your groceries for you. So that, or you can have Giant fix your groceries and you can pick them up. But that's, again, a manner of outsourcing, or in some cases, depending on what we're talking about, it could be offshore, but we're talking about outsourcing, but it relates to distribution. And then in customer service, this is where we focus on quality. The same way value is in the eye of the customer, quality is in the eye of the customer. And with total quality management, it's continuous improvement. We're always trying to make things better. So that's why we constantly need feedback from our customers. That's why companies send you surveys all the time, because they're trying to get information from you in order to make their products better. And a lot of times when you look at quality costs, it's actually cheaper to put in the money ahead of time to make a high quality product than it is to fix a defective item. Because once the item is defective and the customer has it, the customer will complain and tell everybody about it, and then you got to get the customer to send you the product back. It's cheaper to invest money in quality early on. And we know that because cost accountants collect that information. We've done different analysis on that. Now, so that's the value chain and how cost accounting is seen all throughout that value chain. Where do we get all of this cost accounting information from? Like I keep telling you that we collect it, but how do we collect it? Well, we collect it through enterprise resource planning software. This software takes the primary functions of business and it sort of integrates them all. Now, only individuals who work in purchasing are given access to certain items. Only individuals who work in HR are given access to certain items. But some of the information is shared. For example, years ago, if we were talking about production and finance, with production, they may be looking at the customer's order. And if the customer's address has changed, the customer will definitely tell that information or let the company know when they're making the order, because they want to make sure that the goods are shipped to them. But when it's time to send out the invoice, years ago, the finance department had a separate database for the customer. So that new address change was not communicated. So the customer would get their product, but the bill would go to the wrong address. Well, with enterprise resource planning software, we have all of the information being held in a central location on a central database, and the individual departments are given access to the information that they need. So if production happens to update the customer's address, then it's updated in the database. Finance gets the right address. Marketing gets the right address. We're talking about employees. for human resources. Now, someone working in the production department doesn't need the social security number of the employees, but the finance department does, so they can do those W-2s at the end of the year. So everybody gets access to the information that they need, and it does an excellent job of reducing data redundancy. So that's where we get all the information for cost accounting, from those enterprise resource planning software packages. Now, for key financial players in the organization, you guys have taken Intro to Business. You know who the key players are in organizations, the CEOs, the CFOs. But this is from an accounting perspective. And the cost accountant is the one that does the hands-on day-to-day stuff in terms of recording costs, measuring them, producing cost reports to analyze them. The internal auditor typically makes sure that we're following the rules. The controller is the one that's responsible for designing accounting policies. So they come up with the rules that govern how the cost accountant records, measures, and analyzes the information. The treasurer is responsible for making sure that the company has cash on hand. Because you can have all the net income in the world, but if you don't have enough physical cash to pay your bills, pay your employees, you're not going to be in business very long. In addition to that, you don't want to leave cash sitting idle. You want to invest it. So the treasurer is responsible for making those decisions. And the CFO is essentially responsible for all of this stuff. He or she manages the entire accounting function. And because of that, they're the ones that ultimately sign off on financial statements at the end of the period. So ethics is always an issue when it comes to accountants, especially with cost accounting, because the system could potentially be designed to benefit not necessarily the company, but it can be designed to benefit an individual if they can put a little glitch or something in the system so that it captures the information in a certain way, reports the information in a certain way, and the customer ends up being defrauded, or the company itself ends up being defrauded. So we have to be careful with the design of the cost accounting system and always keep ethics at the forefront of our minds. So the same way in financial accounting, we have the AICPA, the American Institute of Certified Public Accountants. We have the Institute of Management Accountants, the IMA, and they have guidelines, they have codes of ethics and things that we need to follow in terms of how we should behave in the workplace. And the IMA has guidelines on how to deal with ethical issues when they arise. So typically when they happen, you want to discuss the issue with the immediate supervisor, unless the immediate supervisor is involved. In some situations, you may discover that the immediate supervisor has been writing checks to himself. Well, you don't want to go to him and say, hey, you're writing checks to yourself. You go to the next person in line. Then you want to clarify all the relevant issues. You want to document. You want to have all of the information there, but you want to do that with an objective third party. Lots of companies usually have some type of ethics hotline where you can report this information. You may also need to consult an attorney on your own behalf to see what you are responsible for reporting and what your rights are. Now, way back when, quick history lesson, way back when, late 90s, early 2000s, the economy was booming. Things were going great. You had all of these companies, all these .com companies being listed on the stock exchange for the first time. People were making tons of money. But along with that, especially in the early 2000s, there were a lot of other companies that were motivated to cheat because people were making so much money. So there were some accounting irregularities involved. And with those accounting irregularities, some companies ended up restating their profits to the tune of billions of dollars, and they were misleading investors. And in some situations, the auditors or the accountants were involved in that. So in the late 90s, early 2000s, accounting used to self-regulate. We made our own rules. We enforced our own rules and we were happy with that. But it resulted in all of these accounting irregularities and people cheating and people losing tons of money. So as a result, we have this Sarbanes-Oxley legislation of 2002. And it really was designed to address the issue of these CEOs and CFOs and auditors at the top who knowingly signed off on false, misleading financial statements. Now, we call that corporate governance, not the knowingly signing off, but the people at the top signing off on financial statements. That's corporate governance. So the intent is to ensure that we have ethics at the top. Now, can you legislate ethics? No, you can't. Well, we tried to. So who was impacted? Typically public accounting firms, public corporations, and accounting firms. When I say public corporations, I'm talking about corporations who have their stock exchanged on or sold on a US stock exchange. And it requires corporate responsibility. And it also put into place some rules that would ensure that these CEOs and CFOs who knowingly signed off on false financial statements, it held them personally liable so that they could go to prison. Because Enron was one of those big companies that was the catalyst for this Sarbanes-Oxley legislation. And a lot of those individuals were able to get off without stiff penalties because we didn't have these rules in place. So we have these rules in place to ensure that the shareholder is protected. So again, CEO, CFO, they have to sign the financial statements. And when they sign it, they're essentially saying that these financial statements aren't omitting any material information and that the information here is good information. It's actually true. In addition to that, there is also an additional disclosure that's required for internal controls. Internal controls are the rules that companies have in place to ensure that the assets are safeguarded and that people just can't easily steal or defraud the company. Now, the last piece of this is the code of ethics, the 4 components for the Institute of, or from the Institute of Management Accountants. Now, in terms of competence, and all this does is it outlines what management accountants are responsible for. So in terms of competence, you have to know your craft. That's why you go through school, you get the accounting degree or you get the business degree so that you have a level of professional expertise and you continually build upon that. You know what your duties are and you perform them in a professional manner. That's what we're talking about when we're dealing with competence. Confidentiality. The wonderful thing about working in accounting is that you get to know how much everybody makes. But with knowing that, you can't go and tell everybody about that. You even want to be careful if you're talking to your coworkers and you're out to lunch. You're talking about the company, talking about financial numbers. People can overhear that information. So you have a responsibility to keep that information confidential, except if you're subpoenaed by the court or when disclosure is legally required. And also with that information that you know, you can't use it in an unethical way to get an illegal advantage for yourself either. Now, in terms of integrity, integrity is essentially doing the right thing when no one is watching. So you want to ensure that you don't have conflicts of interest. You want to be able to carry out your duties at the highest ethical level at all times. And you also want to abstain from any acts that discredit the profession. So any felony acts. And you may be thinking, well, why would I commit a felony? But in some situations, depending on what state you're in some states, this drug may be illegal, and in other states, it may be okay for you to use that drug. And if you get some type of penalty against you because of that illegal activity and you're in a different state, then that's an act that could discredit the profession. You want to abstain from all of those acts. And then finally, there's credibility. And this is about how it looks to people on the outside. Does it look like you're independent or objective? Does it look like you are operating with the competence that you say that you have, or the integrity, or the confidentiality? you turning in tax documents late? Are you turning in reports late? All of those things erode your credibility. And this is a major component of the code of ethics for management accountants. So in this chapter, or in this video, I should say, not this chapter, we've looked at trends in cost accounting as it relates to the value chain. We also looked at enterprise planning, research planning software. We looked at ethics, and we looked at the code of ethics. I appreciate your time and attention, and I hope that you guys have a wonderful day.